Welcome to Investors Insights, episode number 152.
So it's not uncommon. We don't want to get emotional.
Are we in a bear market?
Driven. That's really just people covering their tails.
We're probably going to see some major stimulus.
And then the claw of the bear comes through and takes them back out.
You're listening to Investors Insights with Greg Powell and the Portfolio Strategy team from Five Plan Partners.
Last week saw a strong market. Come on, guys. Clients are saying, are we in a bear market? Because we have said, yes, we are. And so we wanted to address that. Bobby, talk a little bit about bear markets. You had some good points earlier this morning.
So it's not uncommon to have small rallies in bear markets. So let's go back to 2008, 2009. And so there's a 51-day rally in April 2008. There was a 20-day rally in July of 2008. And then there was a 34-day rally in October 2008. And then we all know what happened after that. Right. So it's not uncommon. We don't want to get emotional. We have had about a 2.5, 3 week rally here. Right. But we're still thinking we're in a bear market.
Yeah. So, it was discussed this morning. Technicals are still saying we're in a bear market.
They are.
We may not go into a recession, but bear markets like to have these rallies that bring people in, and then the claw of the bear comes through and takes them back out. Trey, you also brought up about short selling, and talk about that information.
Some of the technicals that we've been watching are the internals of the market. We've been saying since the beginning of this bear market that you get a lot of what we call short rallies, right. And that's kind of what's happening now. Of the top 20% most shorted stocks, those are also the ones that are providing the most of upside. So the average market since February 11th. The top quintile is up 27%. The most shorted stocks are up 27% since February 11th.
In terms of return. Okay, so that's because people are selling the stock before they own it.
Yep. Then they're having to buy it back.
Because the rallies come in.
Mm-hmm.
Okay.
And they get margin calls. So that's showing that's not really broad-based or fundamentally driven. That's really just people covering their tails.
Okay.
And then add on top of that, the volume on up days is considerably lower than the volume on down days. Okay. And so that's showing there's not much institutional support.
Okay. Well, one of the things that, the client has been saying is, but wait a second, the jobs report. Talk about that. Talk about last week.
Yeah. So the jobs report, I think, came in higher in terms of pure numbers than expected. But then you kind of dig in, it had a little bit for everybody. You can find the data. The hours worked were down, was lower than expected, and then the pay was much lower than expected. So we're not having the wage inflation that the Fed was looking for. So you got more jobs, lower wages, so it's kind of a mixed bag.
Right. So it looks like the Fed's going to hold off in March, but June is looking still like it's a possibility. But right now, they're going to hold off, we think.
Right, yeah. We don't see the Fed taking any action right now, but that would be very detrimental. It would. I think at this point.
Yeah, and these are the reasons why the market never moves linearly. It never moves one direction. And so, it moves too much in one direction for too long in January. It's kind of moving too much in one direction now. It never does that. And, in bear markets, statistically speaking, typically 45% of the days are up days during bear markets. Okay. So really the bear only slightly wins, but over the long term, that slight edge, the 55 to 45, provides that long drawdown.
Right. That's a great point that everybody watching this vlog needs to remember. And actually across the ocean there, we got Europe we're going to hear about this week. Talk just briefly about that.
On Thursday, major ECB meeting in Frankfurt. Our prediction is you're probably going to see some major stimulus coming out of Europe. Mario Draghi's under a lot of pressure from a previous round in December not working overly well.
Right.
You still have a growth inflation issue there.
Right.
And so there's a lot more pressure on this meeting to do something substantial. What we think they'll probably do is a lot more sovereign debt buying. They're forecast to do about 60 billion euros for another year into March 2017. We think they'll probably add 10 to 20 billion per month on that. Okay. So that's quite a bit.
Yeah. And that will cause volatility in the market over here as well, depending on what they do.
Yes.
So, you've heard it here. We still believe the bear market is alive and well. We still think that you need to be very cautious here. We're doing that from a conservative approach. And we are going to keep you updated. One of the things about a bear market, there are opportunities there, but you have to be patient and wait. And that's what we're doing. So we appreciate you taking time to listen to this. We're going to keep you updated, and we can assure you that this market's not going to be dull. Thanks again. Talk to you soon.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.